Hi, everyone. Thank you very much for joining us on this Friday, the 20th of March. I'm joined by Rob Enslin, who's a portfolio manager at StrategiQ Capital, who are one of the main discretionary fund managers that Carrick Wealth use. Rob, thank you very much for joining us today.
Thank you very much, and thank you, ladies and gentlemen.
So what we wanted to cover today is the coronavirus impact on the markets, the double swan event that we're witnessing. And I thought it relevant just to share with the viewers today the types of questions that I've been receiving on a daily basis over the last couple of weeks, and understandably so, because clients are very concerned. They're seeing their portfolios going down. And the overarching question that I'm getting is, should I sell? Should I sit in cash and wait for the markets to recover? My general response is that we are in the eye of the storm. It's better just to sit and wait for more clarity, watch from the sidelines. And I think history will tell that by selling now would have been the wrong decision.
Yeah, absolutely. So I think we are certainly entering uncharted waters, whether it be in our real lives and the adjustments we're having to make, and it's certainly in our investment world. But if history is anything to go by, then certainly staying invested, staying the course has always been the correct approach. I think an important part of financial planning is ensuring that your positioning in terms of the risk that you're taking is in accordance with your ability. And that's where financial advice in times like these plays a lot of worth towards its clients. But I think today the objective, I've prepared some slides that I'd like to share with you, and just to provide you with a little bit of clarity as to what exactly is happening, and then give you some insight to how markets are responding to that information, and then provide somewhat of an outlook and how to deal with these types of volatility.
Thanks, Rob. Just bear with me while I get the screen share on, if you wouldn't mind.
Right, ladies and gentlemen, so the topic of today's presentation is the double black swan event or scenario. And the reason for naming it the double black swan event is that we're certainly living in a world where two unpredictable events have taken place in a very short space of time over the last couple of weeks. The first we're probably all familiar with, being the coronavirus outbreak that has really captured the media, but there's been a second event that's also taken place over the last couple of weeks. And that is some disagreements amongst the OPEC regions. So in today's presentation, my objective is to give you a little bit of clarity as to what's happening, then provide some information as to how the market is responding. And as I mentioned, then certainly look back at history and how things have evolved after these types of events. So just a recap over the last 2 weeks or so, or few weeks, there's been a global market sell-off. I'm sure you're all aware of that. And generally speaking, across the board, whether it's in Europe, the US markets or emerging markets, there's generally been a sell-off between 25 to 35% over this period. And these events have really been caused by two unpredictable black swan type events. The first being the novel coronavirus, or COVID-19, and secondly, the Saudi-Russian oil standoff, which is really challenging what we've known for the last 30 or so years as the global oil standard. Are we witnessing the early signs of a disruption there or dismantlement of that world order? The truth of the matter is, at the moment, things remain really murky and unclear, and nobody really knows the full extent of these two forces over the short term and where things will ultimately bottom out. But what we do know with a lot of certainty is that in all past market periods of sell-offs, generally markets dislike uncertainty, and that is certainly what's happening at the moment. And as a result, we're seeing heightened levels of volatility over this period. Just to leave you with something though, generally speaking, like all other market corrections, great long-term opportunities will present themselves. And in these types of environments, it's important, whether you're an investor, a client, your advisor, is to remain calm. And calmness is certainly required when taking investment decisions. So to provide you with an objective view of that type of pickup of volatility that we speak of, we look at the VIX index, or known as the fear gauge. And really, it's a measure that looks at the next 30 days expectations of volatility in this regard on the S&P 500 index. And important to point out, the last time the VIX sort of spiked above 60 was during the great financial crisis during 2008 and early 2009. And since then, we've had periods of volatility, but nowhere near those unprecedented levels that we saw during that period. For the last couple of years, we've also certainly seen a complacency in some regard towards volatility. But you can just see in the graph, this last little period has seen a sharp spike up in volatility to a level of actually going past 80 recently, but this chart shows 71 at a higher level than we've recently witnessed during the financial crisis. Touching on the first black swan event, really OPEC or OPEC plus. So when we talk about OPEC, a bunch of countries obviously decided about 30 years together to determine how oil prices should be essentially managed. They sit around a table and agree to an output price or a volume and essentially manage the price of oil. OPEC plus refers to some of those countries that don't necessarily are formally part of OPEC, but certainly trade alongside OPEC in the decisions, and that would be an example of that would be Russia. So over about 2 weeks ago, we saw something unusual and unexpected during this period. But before we jump into that, just to provide you a little bit of context to what I'm talking about, is over the last 3 to 4 years or so, the US shale gas industry has boomed. Generally speaking, the US shale gas industry requires an oil price above $55 a barrel to be profitable. And in the environment we've been in, we've certainly seen that growth take place. And as a result, the US have quickly become a net exporter of oil and less required or reliant on the traditional Middle East for its oil supplies. Now, by all expectations, a couple of weeks ago when OPEC met for their regular meeting, the expectation was for them to essentially cut oil production as oil prices have fallen off as a result of a fear of a global slowdown, which has been caused by the coronavirus outbreak. However, surprisingly, at that meeting, Russia refused to go along with this oil production cut. Essentially, on that day, which was the 6th of March, we saw the Brent crude oil price fall by 8%. But then I think what was even more surprising was the response by Saudi Arabia that following weekend, whereby they announced retaliation, stating that they're essentially going to then also increase production from their current 9.7 million barrels a day by about another further 3 million barrels a day, so roughly 12 to 13 million barrels a day. They also said that they would offer discounts to regions in Asia, Europe, and the US. And what we witnessed then on Monday morning when we got to work was the oil price, or the Brent crude oil price, down a further 30%. So this is certainly another disruption to the world order as we know it. And the bottom point there is, are we witnessing the demise of a 30-year world oil order, being the OPEC? Moving across to the other black swan, certainly the coronavirus outbreak that has captured the world over this period. Before we jump into some of the details, I thought it's important to just take a step back and just go through the timelines and how things have progressed over this period. Starting on the 31st of December, in the region of Wuhan, or the city of Wuhan, doctors had identified a few patients who had started to become sick from a virus that had similar characteristics of pneumonia, but they weren't able to pinpoint exactly where and what it was coming from. Fast forward by a week, and on the 7th of January 2020, the outbreak was identified as the new coronavirus. On the 20th of January, the first cases outside of China in Thailand and Japan and South Korea reported. Up to this point, you can see in the timeline I've kept it green, because whilst the world was aware of these events, it certainly was not priced into assets. And generally speaking, as an investment community, we were pretty complacent that this was a China / parts of Asia epidemic that would pass. On the 23rd of January, China placed Wuhan, a city of 11 million people, under quarantine orders. This was quite a significant move, just given the scale and the number of people. And as the investment community, it certainly raised eyebrows, and we started to become a little bit more concerned as to the fact of where this coronavirus can go, because really you're essentially slowing down business in quite a big region of that period. And equally, on the 9th of February, the death rate, or the number of people who had passed away from the coronavirus, surpassed the SARS virus outbreak in 2003. Maybe at this point it's important to mention, perhaps the mistake as an investment community that we all made is we looked to his past epidemic and outbreaks, whether it was MERS or SARS, and we used that as a gauge to extrapolate what we thought the future may look like. And perhaps where we underestimated things was that in 2003, China's role within the global economy, whether it be its percentage of GDP growth or the number of Chinese people traveling abroad, various metrics we probably underestimated how important and how globalized the Chinese economy is in the world economy at the moment. To this point, so the bars are running at an orange timeline. I think the real turning point for markets was the 24th of February, and a few key points took place there. So firstly, we saw the jump of the coronavirus across continent. So Italy started to report cases of the SARS virus on its soil, and certainly became a Western world crisis all of a sudden. Equally, the US stock market on that day saw some plummeted over the period at somewhat of a record level relative to what we've seen in history. And then really on the March the 6th, just in terms of the world really understanding that this has become a serious event, Trump signed an $8.3 billion emergency spending package to combat the coronavirus outbreak. And equally shortly after that, we saw Italy place the northern regions of its country under lockdown, similar to what we've seen in China. The next chart just gives all of you just a sense of the rapid pace and contamination rate of the coronavirus. As it stands today, roughly about 210,000 cases of coronavirus have been reported globally, with about 8,845 people unfortunately succumbing to the virus. Importantly to also just be measured in this, which maybe the media doesn't provide us with enough information on. In that number of 210,000 cases, there's actually been 84,215 people that have recovered and are back to, for now, living a normal lifestyle. But the chart below is important. You can see how aggressive and the containment or the infection rate of this virus is. And you can see at the moment, whilst China's managed to contain it, the world certainly is certainly not there yet. And that's the fear which is partly being priced into the markets at the moment. Just to also dispel some myths about the virus, there's certainly people on social media suggesting that should you contain or be contaminated, your odds of survival are very low. That's not true at all. It's very much a virus like flu that we receive. The big difference between it is that its contagion rate is a lot higher than your typical flu. So you can see the mortality rate there. It's on the left-hand side, but certainly anyone younger than 70 years old, it's very much within the realms of a normal flu environment. So to explain that, someone between 10 to 19 years old only has a 0.2% chance of dying from the virus, whereas someone that is 80 years old or older, their death rate there is around 14.8%. So it's certainly a lot more dangerous towards the old, and it's equally a lot more dangerous towards people with pre-existing conditions. So someone who had suffered from cancer, the average at the moment is around 5.6% mortality rate. So the minute that the coronavirus was named a pandemic and moved away from an epidemic, countries across the globe have quickly stepped in with various measures, but the general approach amongst countries has been to reduce the number of trade volume, whether it be humans or interaction across the globe. And essentially, I thought it was important just to understand why we're doing this. So there was some research done by a bunch of mathematicians at the Washington Post and just created a simulated environment. So bear with me, but this is really a fictitious world that we're looking at right here. It's a country of 200 people, and the disease that is spreading is also fictitious. But just something to point out, there's a 100% contamination rate in this scenario. So that means that if I were to come in contact with you, there's a 100% probability that you would pass on. The final point is that during this, although everyone is contaminated or the contamination is high, no one succumbs to the disease. So what we've drawn is, firstly, on the top left-hand chart is an environment where society or a country decides to do nothing. They literally let the disease run rampant and let people move around freely. Essentially what happens in that environment is you see quite a sharp, steep curve of infection rates. And equally, once people are infected and they eventually become healthy, that time is quite short. Whilst many people are suggesting we should just get on with it and get ill, unfortunately the reality is the normal healthcare system in an economy is unable to deal with this sudden ramp up in ill people or people that have fallen ill to the coronavirus. I've got an upward sloping capacity of healthcare because generally the response from human beings over time, should the disease break, is to increase capacity, but there's only a certain speed that they can humanly increase their capacity at. So certainly that's not a preferred approach because the system can't handle it. The other approach is what we saw early on from China and equally what we've seen from Italy, and that is just to quarantine a whole community and essentially not allow people to interact at all. And whilst that is probably more effective than the free-for-all approach, it unfortunately creates a second lag effect because you can't keep people in lockdown forever. And unfortunately, once you let that or open the gates again, you have that second round effect. And it's too tight for comfort in terms of containing relative to the healthcare provider's ability. What we're seeing in the likes of South Africa and some of countries abroad essentially is what we talk about social distancing, isolating yourself, and certainly once you become ill, self-quarantining yourself. And this approach, so in the bottom left-hand corner, the scenario is that a quarter of people, even if they have the virus, are able to move around freely. And in the bottom right-hand, only an eighth are allowed to move freely. The point here is that it flattens the curve significantly, and it allows healthcare providers and systems to adequately provide for the ill. So certainly that's the objective that we're seeing from most countries across the globe. But unfortunately, like all things in life, there's a social and a human element that needs to be looked after, but it comes at the cost of economic growth expectations. So if we turn over to the next slide, this is really, I think, an interesting point in why the financial markets are pricing in the devastating effect of coronavirus. The chart on the left-hand side looks at previous or rolling growth over time, and the shaded bars are essentially historical recessions within the US. And this is forecast from Goldman Sachs. But the expectations are that the world is likely to go into a global recession as a result of this, as a worst case scenario. So really what we're seeing at the moment is the investment community, whether it be investment analysts, portfolio managers, what we're all trying to do aggressively is to forecast what the future may look like and plug those expectations into our numbers. Now, because information at the moment remains so fluid and so unclear, it's creating this big volatility in our pricing and our expectations. I suppose the big question is how much of the bad news is really baked into valuations, or is there more to come and therefore there's further downside as a result? For now, it appears that the US, which was originally expected to have modest growth during 2020, is likely to see a far more flatter, subdued growth environment with likely deep recessions in Italy and parts of the European region. And then certainly China, which is coming off sort of a 6% GDP growth, to grow a lot slower than that over the short period. So essentially, in short term, we may very well witness a technical recession over the first half of this year. It also means that, which I mentioned earlier, because this disease has spread so vastly across so many countries, that the World Health Organization have formally declared this coronavirus a pandemic. Maybe one thing to point out, there's always winners and losers, and what we've witnessed over the last period is as the world has slowed, or the expectation for growth and demand towards safe havens has increased so drastically, bond yields have gone way beyond what we would have all anticipated going into the year. So in terms of context, if one looks at probably the most important bond yield in the world, or bond in the world, is the US 10-year Treasury. Since its formalization in 1847, the bond yield has never traded below 1% until recently. As things stand today, over the last couple of weeks, it's flirted with 0.5% numerous occasions over this period. We've also witnessed a very fast and rapid response from central banks across the globe. I think in this regard, we've learned a lot from 2008 and 2009, and central banks have been very quick to step in terms of their ability to try and create a very accommodative environment and avoid a freeze up of liquidity in the system. So we've seen aggressive interest rate cuts from the likes of the US, who've cut interest rates to 0, Canada, UK, and Australia, to mention a few. And then alongside that, central banks across the globe have stepped in with big stimulus package, whether it be the World Bank, Japan, the US, China, across the world, we've seen these types of reactions. I've included at the bottom, just in terms of a bit of a forward view, and how do things slow down from here or get worse from here, and really hence the scales of justice. So in the red blocks, if we are likely to see an increased spread and speed of the coronavirus globally, and or halts to economic activity as a result of that, certainly that won't be favorable for financial markets at all. On the flip side, if we start seeing a containment and a slowdown in terms of the spread of coronavirus, or even better yet, a form of a cure, whether it be a new vaccine, which unfortunately is going to take at least 12 months or so to come out with, but if they're able to combine existing medicines and come up with a cure, this certainly will be received very positively by the markets. And at the same point, we have created quite a stimulatory environment. So those two factors together are likely to be net positive for the markets. So that's really the backdrop of how we've got to where we are now in terms of those two unexpected, unprecedented events that have taken place over the last couple of weeks. I now turn our attention to the global market update. And as I mentioned at the start of the presentation, it's certainly been a rocky period for financial markets, to put it lightly. We've seen some unprecedented moves in stock prices across the globe. And generally speaking, whether you're looking at South African indices, global indices, S&P, the consensus is most markets are down, but anywhere in the region of 25 to 35% in less than a month's period. Also worthwhile pointing out that we've witnessed 2 days in short concession where the market fell by the most in over or close to 30-something years. Last time we saw those types of market volatility was during the 1987 crash, Black Friday market crash. Another chart that I've just included is obviously when the markets peaked in 2007 prior to going into the financial crisis, the rapid speed of the sell-off that we've just witnessed has actually placed the market returns at the same level. So today we stand exactly where we did in 2007 at the height. So in these types of events, it's human nature to go and unpack and try and understand, well, what does historical sell-offs look like? And the reality is each event is unique to itself and is driven by unique circumstances. But at the same token, as human beings, we behave the same often in an environment or in a panic environment. So what I've included here is just a chart that looks at previous events. These two events included are the Black Monday in 1987, where the market sold off to over 22%, as well as the Lehman Brothers, or the start of the financial crisis. And what is interesting is that humans, in the initial stages of a sell-off, it's very aggressive. So markets get down to 20 to 30% very quickly. However, in the coming weeks thereafter, once the dust starts to settle, the volatility starts to slow down. It's not necessarily indicative of it being the end, but the grind down thereafter tends to be a little bit slower and a little bit more evenly paced. So really with that, we've created quite a negative story. And as clients listening to this, you're certainly wondering, well, am I safe to be in the markets? Where's the end of this and where to from now? And hopefully I can just provide you with a little bit of insights, typically how to behave in these types of environments. So as things stand today, bond yields globally have moved to unprecedented levels. Remember, importantly, that a decrease in bond yields, all else equal, is an increase in capital. So therefore, bonds have played an important role in terms of insurance in your portfolios over this period. We took the decision as an investment house last week, Thursday, given where bond yields had got to, that it was an opportune time to then cash in and take profits on those bonds. Global equity valuations equally, whilst it's uncomfortable at the moment in terms of how they're behaving, they've certainly quickly moved into attractive territory. That being said, we are still not buyers of global equities yet, as really visibility at the moment remains quite low for us. We'd like to see a little bit of improvement in terms of that visibility and a little bit more calmness in the markets before we feel that it's an opportune time to get into the market. That being said, our local market is looking extremely, extremely cheap, remembering that our local market had started to sell off well before the recent weeks. We've actually moved to mouth-watering level valuations in certain levels. And as a result, very stock specific, but we are looking to nibble here and there into investment select opportunities. We've said this for some time now, but our local bond market on a real return basis, despite some overhangs of the likes of a downgrade potential from Moody's, we think much of this is priced into the markets at the moment. And like most asset prices in the sell-off, bonds have also felt the brunt of that. And we think at current levels, with an investor with a medium to long-term outlook, bonds are offering you yields or real yields of about 5% above inflation, and certainly an important building block in our overall portfolio construction. And then I think a last important point is that active management pays very well during times like these. They pay on two levels. Firstly, managing that downside risk, and secondly, being measured when to reintroduce growth assets at the right time to your portfolios. It's human nature to jump into the markets when something sells off, and I think an active manager with a good strategy certainly will be a little bit more measured in that regard. And then equally, in most sell-offs, the opportunities thereafter often do open up for clients. And this is not a perfect science, but it's certainly something to hold on to as a client. Really, if we look at previous sell-offs, what transpired thereafter, firstly, on the long-term perspective, I've identified 3 periods where the market experienced a meaningful sell-off. So first is in March 2003, the invasion of Iraq. The second being the Great Financial Crisis. And then the third was the period where referred to as the PIGS, where Portugal, Ireland, Greece, and Spain, their monetary or the ability of them to pay back debt was questioned by the markets. Really what transpired thereafter was a really attractive period for investors. If you invested in the S&P at that point in time, it went on to return 270% for the next 5 years, or around 30% annualized. And equally during the financial crisis or during the PIGS, we saw returns of 160% each, which is about 20% a year. A little bit shorter term, and just to understand previous sell-offs, other sell-offs, so I've included there the Black Monday in 1987, the Cold War tension, the Johnson Global Society Program, and then the Suez Crisis and Hungarian Revolution. During those periods, where the markets were down 20 plus over a short period, you can see what the S&P did for the next 6 months thereafter. So anywhere from the region of 10 to 22% over that period. Just to put it also in a little bit of context, so previous sell-offs of the S&P 500, which have been 20% or more, there's been give or take 9 or 10 over that period. And I've also included that during December 2018, it wasn't quite 20%, but it was virtually there, 19.8%. How many days it took to get to the bottom or for the market to trough. And what we're currently witnessing is something we've never seen before. It's taken markets, as of yesterday, down 29%, and it took just a mere 21 days to get there, which is the fastest on record. Also, what's important to take out is the column on the far right is how long it took once we had troughed to get back to those previous highs. And stripping out some of the big outliers, a median number is typically around 6 months. That's based on history. Now, I know by no means you can't base what's happened here and expect it to be faster, but just important point to make out, it has been one of the fastest sell-offs. We don't know how long it will take for us to return to our previous highs. So really, in summary, in closing, a few things just to point out. So firstly, going into the sell-off at StrategiQ Capital, we were certainly well positioned. We were underweight risk assets compared to our mandates across the board. We certainly weren't underweight our risk assets because of coronavirus expectations. That was certainly against anyone's sort of house view or expectation. But we felt that asset prices across the board, particularly in developed markets, were looking a little bit toppish or overly expensive. And the decision was taken in October 2019 to lighten risk assets. Secondly, our moderate duration bonds offered some protection during the sell-off, which I did mention. We took profits last Thursday as a result of that. And therefore, at the moment, we're sitting in cash or cash-like investments, referred to as our dry powder, for when we do deploy capital back into risky assets, depending on the mandate, but typically around 16 to 25%. Global equity valuations are looking far more palatable from our perspective and our viewpoint, but we're certainly not rushing in at this stage, waiting for improved visibility. Central banks have made financial conditions extremely accommodative, so when the time does come and when it is an opportune time to get back into risk assets, the backdrop or the environment that we find ourselves is very accommodative. Importantly, so our robust investment framework and optimal number of underlying holdings has provided us with great clarity and visibility an ability to be nimble in this type of environment. So it's when you're deciding on an investment manager and they hop on the investment process, it sounds like these that it's important to understand that and understand how they deal with the investment approach. And then, like all previous crashes, great opportunities will emerge. Coronavirus will pass, and lower oil prices ultimately over the long run will be quite stimulatory for the global economy. For the likes of South Africans or most regions in Africa, filling up petrol in the tanks is going to be a lot cheaper than it used to be. And then finally, just calmness and discipline in this type of environment is essential to make the right decisions for your long-term wealth. So with that, I thank you for your time today. Thank you very much, Hans.
Perfect, Rob. Thank you very much. In conclusion, there are 3 points that I would like to close with. Number one, markets will recover. Number two, this recovery will come at a time when we least expect it. Number three, once the dust settles, asset managers such as yourself are going to be able to quickly identify and take advantage of the potential winners. I wish everyone a safe weekend, and thank you all again for joining today's webinar.